Well, great to see you this morning, Will. It's Thursday morning in Sydney when we're recording this. Well, I guess we'll start off with the big news this week, which really wasn't much news at all, which was the RBA decision on interest rates. As we expected, no change, although Governor Michelle Bullock did reiterate that the bank will remain a careful eye on inflation and will be data dependent. So interest rate cuts probably pushed out a little bit further than they were a couple of months ago. And yet the market reacted very, very positively. I think the index was up about 100 points. What did you take the RBA announcement?
Well, I guess it's all not so much about what the RBA said. It's around, I guess, what they didn't say. And so everyone in the market had been, I guess, becoming increasingly concerned, and that's, people who invest and people who commentate more so are talking about continued resilience in the economy. And it almost getting to a point that we were even hearing, and it actually was seeing in market pricing, that there was actually a marginal potential for a rate rise. So it was more so about, and of course, again, we spoke about this a few weeks ago, that's not a central case. And for Michelle Bullock just to continue the rhetoric to say, look, we are seeing easing inflation and expectation is that we will be data dependent. But we are probably more so on the easing cycle. So we saw it in the currency. We saw the Aussie dollar, which had been creeping up over the last couple of weeks. We saw that move lower, and we saw the market have an exhale of relief that there is no change to the continued trajectory of interest rates, which is most likely going to be down, which again is supportive for risk assets.
Yeah, and just to put my view out there, I think the media is always looking for a headline. And so once the inflation data disappointed, there was always going to be some narrative about the need to possibly increase interest rates. But I think that remains a very slim path forward. And it was quite interesting also just to notice that the Swedish central bank overnight cut interest which seems to be the general trend. They went from 4 to 3.75. Yes, there will be delays by most other central banks, but I think the probabilities are that rates are at a peak. Well, let's switch to the Macquarie Investment Conference. Will, I know the investment team is attending the Macquarie Investment Conference. We have literally dozens and dozens, if not hundreds of companies presenting updates, giving presentations, taking questions. Must be very exciting attending, and I'm sure there's a big crowd there. What's it like at the investment conference? What's the mood like this year?
Yeah, and I think that's a great question, Paul. And the mood is quite buoyant. It's a fairly well-packed conference, and it's really interesting to see which way the crowd moves. And so companies that we expected to have rooms filled with people, perhaps empty, and then we're also seeing, standing room only in a few places. And that's so he's talking about what are the hot and the cold sectors. And I guess, we as an investment group certainly keep an eye and understanding of where the crowd is moving, but it's also really important for us to understand where they're not, and that is usually where the opportunities lie. So yeah, it's fantastic and right, and there are probably 50, 60, 70 companies presenting, and it's not just companies, it's we're learning about thematics and trends, and it's really the marquee place for companies to come out before the end of the financial year, meet with investors and talk about how they're going. So yeah, we're out here turning over new ideas and testing investment theses.
Well, let's drill into that a little bit further. So what were the hot companies and the themes that kept on coming up, and what are the overlooked companies where there's only a few people in the room, which creates possibly an opportunity?
Absolutely. So look, if I try and simplify it, three key trends that we're seeing throughout the conference, and they won't be a huge surprise, but what's interesting is the amount of companies that are moving into this space, because these are sustainable growth, long-term trends, or efficiency programs that everyone's looking to get on top of. So I guess if I'm thinking We've talked about it before, the energy transition. More companies than we probably thought. So when we're thinking about that, Macquarie, it's a key feature of their discussion. So the big Australian bank, always dynamic, really pivoted their business 5 years ago to fund it. But what's interesting is that in the most recent result, Macquarie's actually taking those assets that they funded, the construction is underway, and it's almost a back to the future. They're starting to move those into funds. The old infrastructure business that came out 15, 20 years ago that built Macquarie, we're seeing them move those risk assets into the funds management business, higher quality earnings. So really interesting there, but all based off the back of the need to invest. So megawatt hours in solar, wind, all that. So I guess as well, it's something we talked about, Worley, again, is positioned really well to build them. Someone's got to build these things, and there's just excessive demand, really strong dynamics there as well. So I guess those two things, Macquarie remains a key stock for us. We're seeing capital markets pick up, a reference to, you can see how filled the rooms are. Markets are relatively buoyant. We expect M&A to continue, and that's usually good for Macquarie, and Computershare is another name there that we're interested to look at. I guess the other trends, I'll just AI as well. We're seeing companies that are truly exposed to it, NextDC and alike. But it's interesting that, again, every company where they can to try and get favour with the audience is dropping these terms as well. So it's really interesting for us to spend the time working out who's really using it as an efficiency tool to increase their competitive advantage, and who's just using it as a term when it's actually just another term for what they're doing within their normal system day to day. And I guess the last bit is private credit. Look, lots of interest there as well, and we're doing a lot of work on that internally.
Just explain private credit. Is that another way of talking about private debt, where kind of non-bank lenders lend to the smaller end of town or the mid-size and lend their money on, either asset-backed or whatever? Is that what we were referring to there?
Absolutely. So there's been a really interesting trend over the last 5 years, and it was post, the Royal Commission and the changes in the risk weighting of certain assets on our large bank balance sheets, the ones that we know well, Westpac, CBA. They've actually withdrawn from a part of the market where there's an essential need to kind of fund different risk profiles, and institutions such as Macquarie or even smaller family offices and such have been filling the space to lend to individuals, which on shorter term, but also with higher returns. So that what we're seeing with the increase in interest rates back to these higher levels again, we're seeing a relatively robust economy. So, and credit spreads have been reflecting that through the tightening. We're able to access 9-10% equity-like returns with far less risk. So Macquarie Bank, as an example, have got about $20 billion of their balance sheet allocated towards this sector, and more. And I guess that is more likely going to continue to grow. And we ourselves, what we're seeing within Climb is that we've recently been looking at what we can do within our Climb Australian Income Fund. We've made our initial investment into private credit, and that's really attractive, higher returns, lower risk. We're also seeing strong demand and supply as well from new entrants around what is usually traditionally a wholesale or an institutional type product, but with our retail investors able to access that too. So it's a really interesting time, and we look forward to bringing those opportunities to our clients.
Okay, thanks, Will. You mentioned the big banks. I think the CBA's trading update for the quarter was out this morning. The banks, how are they going? I think Westpac responded very well to its results, and most of them have announced buybacks and strong dividends. Is there something you could say about the banks as a sector?
Yeah, well, absolutely. The banks have been a really interesting area of the market. What we've seen is it's almost they've just been resiliently strong. The expectation is that we would see increased competition, as well as the tight net interest margins that they're able to earn at the moment, starting to challenge the banks. But what's really been the star within the banking sector is just the continued resilience of the consumer and corporates out there. So the debts, they usually allocate a certain amount of bad debts that they'll have in the future. And that's how banks think about their future earnings. But really, there's very low loan losses happening at the moment. So what we're seeing for us as institutions, we're seeing earnings expectations either being retained or actually increasing. And then at this point, given the low growth out there at the moment, so there's not a lot of lending happening, these banks don't have to hold the capital that they have on the balance sheet. So what we've seen is the release of that through the buybacks. So yeah, the key trend in this mini reporting season that we're seeing is robust results across the board. Westpac appears to be getting their house in order. I haven't had a chance to look at CBA today, but it's always really interesting. But across the board, every single one of them have been giving money back to shareholders, or at least buying back their shares, boosting their EPS, releasing that excess capital. So better than feared, solid enough, and the dividend yields look sustainable at these levels.
You referenced the resilient consumer, coping with pretty high mortgage rates and high rentals and so on, high food prices. Are we seeing that coming through in the retail company results? I've noticed that JB Hi-Fi, I think it's Baby Bunting, came out with slightly disappointing earnings. Any trends emerging there?
It's really interesting at the moment. We are seeing a more cautious consumer. Even at the more staples level, Woolworths, Coles, they're flagging that the consumer is being more selective. What was interesting, if I jump to staples, and our preference in the space is Coles, what Coles has done to win share within the market more recently is spend a lot of their time and energy on actually filling out their private label range. So people eating out less, but wanting to still treat themselves at home. So high-end private label is doing really well within the supermarkets. So there's still money to spend, but we're seeing people being a bit more cautious. So you're right, JB Hi-Fi, Baby Bunting, even we'll have Super Retail as well this morning. They're usually a good read on the economy. We start to see people keep their hands in their pockets, and the share price have responded. The consumer discretionary sector is down, has been weak of late, but I guess a large part of that sector is Wesfarmers, and fantastic stock, great allocators of capital, just showing themselves to be the premium retailer in Australia too.
Thanks, Will. We've probably only got time for one more question. I think, is there a stock that perhaps has been either uncovered at the conference or something that we've been working on that you're excited about, that you're willing to share with the audience today? Any last mentions before we conclude?
Well, there are many great opportunities, and we look to do some more work on those, I guess, over the next week coming up. But one stock that continues to perform well, and it's been a recent addition to the portfolios, is GQG. So a fund manager that really focuses on international and emerging markets. At the moment, they appear to be winning strong fund flow and performing very well. So look, as a fund manager, it's not a traditional space that we do invest in, but we have to respect the fundamentals. And when there's industry growth, and we remain positive on markets, a company that itself is differentiated and winning share, this international fund manager, GQG, looks as though it continues to gain share. So it does a monthly update of fund flows, and at the moment it's winning a bit over $1 billion, or $1.7 billion per month at the moment. And to meet expectations for the end of the year of where the broad market has it, they're running about $1 billion above every month. So extraordinary growth rate, and it's more of a cyclical stock, but we really like what we're seeing at the moment in that name.
Thank you so much, Will. It's a real pleasure to have you on The View, and hopefully by next week we'll have John Abernathy returning.
Yes.
But to our audience out there, thank you so much for listening in, and we look forward to seeing you again next week. Thanks, Will.
Bye-bye.